Welcome to Wall Street Mojo. To know about this video, watch the video till the end. And also, if you are new to this channel, then you can subscribe us by clicking the bell icon that's given below. Let's begin with the concept of a going concern concept. Now, what this concept is all about, we'll try and get into a very detailed format. Now, first, what is going concern? See, going concern concept means that, that is an ability of any business to run in the most profitable for any indefinite period of time. And until the concern is stopped due to some bankruptcy and its assets were going for liquidation. So when a business stops trading and deviates from its going concern principal business, then there is a highest possibility that the concern would likely to stop delivering the profits in terms of near future. So those a business cannot, you can say, bear losses for a longer period of time and erode the shareholders' wealth. So a healthy business shows what we call as the revenue growth, and profitability grows with the so-called margins improvements and growth in the product sales. Now, on the going concern assumptions, the primary going concern assumption is that the business will run forever until the business stops due to the bankruptcy. So there are some assumptions that is involved in here. The primary going concern assumption is that the business will run. Okay. We'll start with the first one is the acceptability of the core products. Now, a business runs on the going concern basis of the products and services they offer to the consumer. The pulse of the business, starting from the fruit seller to an MNC multinational company selling IT services, would be the same. So the owner or the top management has found new customers and maintain its existing customers so as to maintain the organic or inorganic growth of the company. Retention of old customers and expansion through new customer acquisition would help to make the business more profitable, and it aids towards the volume growth of the product. Now, the product should be reasonably priced and innovative in nature so that it can beat its peers and retains going concern value of its customers. Okay. Now, there is a thing called, second is called the margins, the growth, and the volumes. Now, see, the financials of the business should speak about the sustainability of the business through top line and the bottom line growth along with their higher operating and net profit margin. So, an ideal growing concern should have a higher number of product sales compared to the last year. Now, there is a thing called cyclical revenue growth and profitability. Now, see, another instance where there might be not be constant top line and the bottom line growth along the increased margin is when the demand of the product is cyclical in nature. So for example, there is a rise and fall of volume in the steel products may affect the revenue, and due to its fixed costs the profitability may get hindered. But the interesting part of the business is that it still is following the basic fundamental, and due to the nature of the business is getting much more a hit. Now, we'll start with an example here to get a much more deeper understanding on this concept. This is the snapshot of a going concern example wherein the company has robust margins and growth. As you can see, there is the data of revenues and margins and all detail that is given to us. And from the above financial, we can derive that the revenue growth and the net profit is quite consistent for the page industry, manufacturers apparels for jockey brands during financial year 14 to financial year 17, and the revenue has increased significantly from 1194 to 2152. That's $1 billion to closely around $2 billion. That's completely a 50% growth. Revenue has increased significantly. The net profit grew from 153.78. This is not 1 billion, it's 11 billion, and it has grew to 21 billion. And in case of net profit, it is 1.53 billion to 2.66 billion. during the period. So the gross profit margins has been around 50 to 6%, following by the healthy EBIT margin, and which is more than 20%, and robust net profit margin that is around 12 to 13%. So this shows that the business sustainability due to higher product acceptability and vivid from the revenue growth and the operational efficiency that is visible from the sustainable EBIT margins. The next that you can see is the going concern example of Tata Steel here. If you see for Tata Steel, this snapshot, due to the cyclically demand of the steel across the globe, the revenue has gone down from 1491.30, that is, as you can see, the amount has significantly declined like anything to 112 in financial year 17, and so is the profitability from 3663, that's 36 billion, to negative. I mean, that is far-fetched amount, but due to higher finance cost, you can see the finance cost has been increasing, and this increase significantly has screwed up the whole thing, and certain exceptional losses in the bottom line has got slashed. So when does this going concern concept turns out to be dead? Okay, see, as per the going concern concept is basically the accounting standard financial statement that reveals the true and the fair value of the business, again when the sale of the asset does not question the capability of the business, and shutdown of the unprofitable businesses or the branches units, and does not imply that the concern has stopped performing well unless there has been the net loss from the overall business and reduction in the shareholder fund. So thus the red flags can be summed up as follows, that inability of the business concern to pay its what we call as the obligations, and in spite of the sufficient restructuring, and in spite of several steps that have been taken by the management. So if the business fails to deprive or derive profits, there has been the exclusion of the top management, then the shareholders might think of what we call as the exit. And the next is, the audited reports with the full financial statements, okay, that are published yearly, whereas only income statements data are published quarterly. So when an accountant and auditors, when they questions about the operational efficiency of its long-term assets, while to meet its dues, the assets are being sold, and when they are unable to report the financials within the stipulated time frame, is a matter of a question for the management. So there must be some instances where the management has not given any true and fair view, or the fair view of the business to the auditors. Now, if you see that when the continuous losses where the other firms are generating profits in the same segment, loan defaults, lawsuits against the company, that raises questions regarding the performances of the company, which can be really be hazardous thing. So on the final conclusion note, you see the prime aspects of the business remains the capability and the integrity of the management, and proper business foresight, and the operational efficiencies are required for a business to sustain and remain profitable for a longer term. And the cycle of the business during the economic recession is crucial when it determines the ability of the management when major firms fail to generate that level of profit. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you.